Hello and welcome back to the Passive Pulse series where we discuss passive funds and ETFs. And in today's episode, we'll talk about fixed income passive products. So let's begin the journey into the world of passive investing only with Passive Pulse. And joining me now is Mr. Arun Sundaresan, Head ETF at Nippon India Mutual Fund. Welcome to the show once again, Arun.
Thank you very much, Gitu. Pleasure, talking to you.
Arun, let's start with fixed income passive products. I mean, this is a time when, interest rate scenario is turning out to be the other way around. We thought their interest rates would come down, but now inflation demon is back. So what are fixed income passive funds and how do they work in this kind of a market?
So for our listeners who are familiar with fixed income funds, the fixed income passive funds are very similar, except that there is a framework which has already been defined and an index that has been constructed. So this framework and that particular index, the strategy will outline what will be the asset class. For example, is the investment only into government securities? Is it into SDL, which is state development loans or state bonds, corporate bonds? So those asset class details will be available to you. The rating profile, if it is corporate bond, is it AAA? And by the way, right now, in the passive side, only AAA bonds are allowed, nothing beyond below that. So that rating profile also is something that you will know. And many of these products in the fixed income passive side are in the target maturity fund. So which means that when is the scheme maturing? So right now we are in 2025. The scheme could be maturing in 2028, perhaps. So you clearly know that between now and 2028, this is a 3-year maturity product and will keep rolling down. So all the details in terms of asset class, the rating, the maturity profile, the underlying securities, all of that is known to you upfront, and therefore the risk return expectations are amply clear in front of you. Now, how does this differ from a normal fixed income fund? A normal fixed income fund, it's up to the fund manager to decide from time to time what type of securities he buys. The rating profile, today it could be 90% AAA, tomorrow it could be 85%. Today the duration could be, maturity could be 2.5 years. Later on, reduce, increase, depending on his views. So to that extent, it's very actively managed. It also brings to that extent an element of uncertainty. That's left to the fund manager to manage that. But against that, a passive fixed income fund, you have clarity. So if that's exactly what you want, if you want to, this is a PSU corporate bond, AAA with 3-year maturity, and that's exactly I want. You can go and invest into those passive products. So that's the big difference.
And what are the benefits of using passive products for fixed income exposure?
Precisely this, you know the framework. So there is nothing more or nothing less. So you will be having that confidence, saying that you get what you signed for, right? And it will remain the same way now and forever. It will not change. So a lot of times, what could happen in a active fund is when you invest, you could invest basis the current parameters, the portfolios and things. For various reasons that could undergo changes, and that may not be aligned to your objective as to why you signed up to invest in the first place. On the other hand, the passive fixed income funds give you that clarity that this is exactly what it is, and it will remain label throughout. And that certainty is something especially fixed income investors would love.
Arun, you talked about the various kind of securities that form part of this product. So what is the weightage that you prescribe? I mean, you said AAA bond, corporate bonds, you talked about government bonds. So what is the kind of exposure? What percentage goes into which product?
So that will depend on the index itself and the fund based on the index, and any combination is possible. For example, that can be an index with 60% GSEC and 40% corporate bond.
Okay.
Another product could be 70% SDL, which is the state development loans, and 30% AAA. So all combinations, which is what I said, in terms of asset class, the mix of asset class, a product could be for 3 years, it could be for 5 years. So all types of combination of products are possible. They're available even today in the market, depending on the suitability, depending on what exactly a client wants. Suppose you as an investor want a 5-year kind of a product, you may be able to find one. Someone else does not have appetite for a 5-year product, but they want to look at a 3-year product, and that too only in GSEC, maybe there is a product. So there are various combinations possible, and they are already available with Nippon and in the market. So a plethora of choices are available for investors.
Arun, we all know from last 3 to 4 years, it has been equity and equity and equity. But now people are returning to the fixed income funds and passive products that you explained. How should investors, approach these funds so as to diversify their portfolio?
Well, first and foremost, fixed income, when compared to equity or any other asset class, tends to behave differently, which is why you need to have those, if you're talking about diversification. And what better time to talk about diversification than now? If you had talked about diversification about 4 months back or 5 months back, when equity was continuously doing well for the last 1 year, 2 year, and 3 year, then the approach would be that equity is giving this much return. Why look at anything else? But you're clearly seeing that in the last 3 months and even this Jan, since the turn of this year, it's been a massive correction, right? So you will see huge negative returns. Whereas fixed income, on the other hand, yes, it can also be volatile. Sometimes the expectation that rate cut would happen in the US because of inflation and jobs data, that could get a little deferred. So sometimes the yields can move up, and debt can also go through that. But by and large, because there is an element of underlying coupon, there is an element of inherent income built into fixed income. So that, when combined with another asset class, can help you diversify. So therefore, if you think about your overall investment, it's important to have not just one exposure. It's okay to have that as long as you're prepared to go through that topsy-turvy ride. It can go up, come down. Whereas adding different asset classes will help you diversify. Your return profile will be moderated. At the same time, your drawdowns, your risk also will be fairly mitigated. So that's where fixed income comes in. I think it's essential in everybody's portfolio.
Very true. How should investors assess yield, duration, and credit risk in these funds?
So as far as passive fixed income funds are concerned, you will have clarity about all of these things. As I said, the asset class, whether it is pure GSEC or corporate bond, the rating profile, so everything will be there. And generally, these are available in the target maturity category, which means that the maturity date also will be known to you upfront. So therefore, everything related to the product, very clearly. And therefore, unlike equity, this is very straightforward. If you say that a product has a duration of 3 years, you clearly know what it entails in terms of, you can do a lot of scenario analysis. So the yield of the product will be known, the YTM, yield to maturity. And then, given the duration, if interest rate goes down by a certain amount, what could be your return? If it goes up, what could be the impact? All of that can be mathematically put out as a scenario analysis, and you'll be able to visualize what you're getting into. Having said that, generally, when you buy a target maturity funds, if you buy and hold, see, for example, today, if you're getting into a product which has let's say, 8% YTM, yield to maturity, if you're holding that product till maturity, you are more likely to get closer to that 8%, regardless of what interest rate movements go up and down. So in a way, it works like FD. So one is you can take that approach, saying that, look, this is a 3-year product. I am getting this yield. I'm comfortable with that. You go ahead and do that. Plus, those products also give you the additional flexibility or the optionality of liquidity. It's not necessary that you need to hold for 3 years. In the meantime, in the next 1 year, or at some point in time, for whatever reason, you need to take money out, or at that point in time, the market is good, your returns look like 8.5%, 9%, you want to book profits, you can do that.
Why not invest directly into the bonds? Why not buy it directly? Why go through passive investing?
Okay, so a couple of points. One is direct investing. You will be investing in one bond, or you're investing. So you will have to do your own research, which bond, and So typically you will not be able to diversify, right? That's point number one. Whereas in the fund format, whether it is in passive or active, you are getting a diversified portfolio at the click of the button. So it could be 20 different debt securities, 25 different, sometimes even more. So you get that. The overall contours are anyway clear to you. This is only GSEC, this is only corporate bond, AAA rated. So all of that, it's clear, so that you know what you're getting into, but you're not going through the trouble of identifying one security, the second security, and so on and so forth. So this is a big advantage, number one. Second, also is an important advantage. When you buy bonds directly, you get coupon, you get coupon payout. So every 6 months or every year, you will get, for example, if there is a particular bond, the coupon payout is, let's say, 6% or 7%. You invest 100 rupees, you will get 7 rupees as payout. And you will have to pay income tax at that point in time. Based on your income tax rate, it will be taxed at full rate. So you will have to pay tax. So every time you get this 6 rupee, maybe you pay 30% of that. What you're left with is 70% of 6, which is 4.2 rupees. So money, your cash flow gets impacted to that extent. On the other hand, in a fund format, we have invested into that particular security. We get a coupon, and that coupon we don't pay tax, because this is mutual fund. We don't pay tax. This is our trust. So therefore, we get the entire 6 rupees, and that gets reinvested also quickly in the same market. So as an individual investor, you get 6 rupees, right? And you lose income tax, and most likely you will not reinvest that remaining 4 rupee 20 paise also. You will, so that leads to drag in returns. So this compounding effect of coupons getting automatically reinvested, ultimately you pay tax only at the time of redemption. So if you're redeeming after 3 years, or after whenever the scheme is maturing, or whatever it is only then. So there is a very clear tax deferment that happens. Plus, during the entire period, your coupons also get compounded. So the end result is that between fund and direct bond investing, because of this concept, you will sometimes lose. Your return difference could be as high as 1%, 1.25%. So the fund route that way is far beneficial.
Thank you so much, Arun, for explaining us how fixed income passive products actually work and can help in diversifying one's portfolio. It is a pleasure speaking with you always, Arun.
Thank you very much. Pleasure talking to you. Thanks.
Thank you.
An investor education and awareness initiative of Nippon India Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.